Hey, it's David. I wanted to talk to you about some slides that I received from a friend of mine, Chuck, who received them from the Canada Housing Mortgage Corporation. And what these slides talk about is basically where things are going and what's happening in our economy and in our market. And this comes from senior analysts that have formulated and put all this information together. And I thought that I'd share it with you. Now, these are likelihoods and these are predictions of where things may be going. Obviously, no one can predict the future, and if they did, they'd be really rich. But for the purpose of this is just some information that I thought I would share with you. And these are my opinions that I'm putting out onto this. So before you ever buy a property and everything else, you want to make sure you get the right information and whatnot. So I'm just going to walk you through the slides that I have here, and hopefully they help. So the first slide that we have, there was about 18 slides that Chuck pulled off. So I'll go through the same ones here. This one here, the first one is the annual change in employment. So where things have been, we had a dip in 2009, but generally speaking, the employment has been pretty, kind of steady over the years. But this year, they're expecting that we'll have a little bit of a dip. The next one that we have is carrying cost versus wages. And, when one looks at this, this is the forecast or their prediction of where 2012 will be, is the change in mortgage and carrying costs is pretty much going to be, pretty much stay the same. And the change in wages is normalizing. It's pretty much staying the same. So we'll have pretty steady numbers for this year. This is what they're saying. Now the next slide that we have is the average equity accumulated in 5 years. And this is a real interesting chart because over the years, the last number of years, 15 years, 20 years, you're starting to see these numbers start to increase, and everyone's wealth has increased in real estate. And then we had a little bit of a dip of it in 2009, but here we are today. This is 2011. 2012 now that we're going into it here. And this is their prediction. This is where they think things are going to go. And they think that, it will slowly start to drop off a little bit. And that can be contributed to maybe higher prices with regards to interest rates. And when interest rates rise, as the economy improves, prices of homes tend to come down. It's like a little teeter-totter, and this is what you see in the marketplace. Now, over in the US, what they had happen to them was a lot of people were putting huge amounts of money into their home. People were actually getting into mortgages they couldn't afford anyways. But in Canada, if you do want to get these lower rates, you have to qualify at a 5-year 5% rate. And so by taking that into consideration, if you can get that approval, then you can get your lower rate. So when the price of the home start to go up, the affordability factor is still there. You can still make those monthly payments. But in the U.S., what tended to happen is a lot of people put money into their homes thinking that it would continue to grow, but it didn't. And it started to contract. And when it did, a lot of people who put a lot of money into their home with regards to fixing it up and everything else, they lost their life savings. Devastation occurred in the U.S. and they're still battling the mess right now. So what we're starting to see here, so we have a couple of things that are different in Canada with regards to people who are getting into the marketplace. Okay, but this chart here. So what we can learn from this chart is, don't put all your eggs in one basket. If you're going to have money that you want to invest, yes, you can have real estate, but don't fork out so much money for renovations and everything else. Especially if you're going to sell in the future. Typically, what I see is people will go ahead and they'll renovate their house the year that they plan on selling it. So they do the renos, 2 months out, and then they list it. So it's not like you're doing all the work 3 years ago and then hoping to sell it at this price and then the market goes down. So that's another way of looking at it. Or you could take, if you had like $250,000 in a bank account, or you could take that and you have a mortgage for $250,000, technically your mortgage is paid off. But if you go ahead, with interest rates being so low, does it make sense to pay off that mortgage, or does it make sense to go ahead and maybe diversify and invest in some other things and get a higher rate of return? It's just a personal preference. But again, that's just some things that we can learn from this slide. The next one is the annual change in number of households. And so huge reality check on this one. But here we are in 2011 at the end, and then this is the prediction of the future where it's all gray. So what they're seeing is people aged 45 to 64, we're going to start to see a big drop off. And as they slowly drop off, we're going to start to see an increase of those 45 to 64-year-olds turn into 65 and 74-year-olds. So you'll start to see those are the baby boomers, and we'll start to see that kick in and increase. 25 to 44-year-olds we're seeing an increase as well. And then quite amazing is the 75-year-olds increasing as well. Now, one thing that you need to understand is as we live in our aging economy, our public services are really going to be have a huge strain put on them, because there's going to be more people who are retired than there will be that are working. This is what in the next 50 years, this is what they're predicting. So there'll be some huge changes in our economy and things like that. And I have friends of mine who are economists and who are mortgage specialists, and that are right into this, and that's where the numbers are. That's where things are predicting to trend out to. So for the next 50 years, there's going to be some changes. Market conditions, price growth. We've seen a lot of price growth. These are two graphs in one. So the first one is the price growth. We've seen some healthy price increases over the years. This year, they were just seeing that it'll be pretty stagnant with regards to price growth. And then with sales to new listing ratio, what we're seeing is for every 100 homes that are listed, this year, last year, there was 60% of them that sold. This year, they're saying that it'll be 55%, so a little bit of a change. The next one is inventory of sales, or singles. And this is new versus resale. So you'll start to see with the new, there's been a significant drop-off with the amount. And I think you can contribute that to HST. So homes that are priced above 400,000 have HST on top of that. So with that, what we started to see is the increase in resale homes, and that's been pretty steady. The other trend that we're starting to see with new home sales is singles and townhouses. So there's been a drop off with new single homes and an increase with townhouses. And this is just what they've done over the last 4 years or 3 years. And then the average selling price, you have new and you have resale. So with new singles, it's more expensive to buy from a builder, and then it's cheaper to buy from like a resale home. But you can maybe get some benefit from buying from a townhouse from a builder, because it's cheaper than it would be if it was in resale. Now, some things to think about. If you're going to be buying a new house, you have your property to sell as well. Now, if you buy, let's say, a townhouse and you're closing maybe out a year from now, the marketplace could be very different than what it is currently today. So if you wanted to go ahead and sell your property a year from now and the market shifted, now you're going to get less for your home than you would have been if you sold it today. So that's one of the things with resale. So there's big risks when you buy new home, because the new homes are not ready for a period of time. So sometimes you can get hit doubly on that in the case where your home is not worth what it was, and you've gone ahead and paid a certain amount for that new home, which again may not be worth that anymore. So you're kind of hit on both sides. Just something to think about if you're thinking about going down that road. Actual versus required household income. And with this is they're predicting that there'll be a little bit of a drop off with the amount of required income needed for a maximized amortization of a house in 2012. And so we're also seeing that the actual income is increasing. So what that means is the ratio between the two will spread further, will increase, which will allow you to actually have more income for savings and things of that nature. So it's one of the things that they're predicting in this, and that's a good thing. People can save more. Next chart is the 5-year rate of the mortgage, and it's at a 60-year low. Like, this is huge, guys. I mean, I remember my folks, they were in the 80s, in the 1980s, and they were paying, I think, 22, 23% on their mortgage. And so, we've obviously seen huge drop-offs with the price of rates in Canada. It's right now it's lower than June of 1951. So that's huge. But you got to qualify at 5% though to get the lower rates. Now the next one is a scary chart, and it's a scary chart for a lot of economists and bankers and investment portfolio folks, because what we're looking at is the debt to income, and it reached a peak in 2011. So a lot of people owe more than what they make by a debt ratio of 150%. That's huge. So hopefully, seeing some of the affordability factors in the previous slides, we can start to see people save a little bit more money and get out of debt from where they are right now. 3-year price appreciation that we're seeing across the GTA, and places down in Milton and Mississauga and Whitby and Ajax and all the way up into Barrie, they're seeing healthy increases of about 20%. But then you start getting into some other areas where it gets really crazy, like Vaughan is nuts and Markham is crazy as well. But Richmond Hill is like literally on fire. If you have a home in Richmond Hill, you're seeing gains of up to 30% over the last 3 years. So it's pretty hot. Now some of the other areas like Orangeville, I mean, very affordable. They're not seeing these huge numbers, but they are seeing more of a stable market is what they start to see. Now the most affordable and least affordable areas in the greater GTA. And you can see that, if you live down in Oakville or Richmond Hill or Vaughan and any of these places, King, it's very expensive. Toronto as well. And so those are some of the least affordable areas. Some of the most affordable areas, they can get a little bit further away, a little bit more of a drive, so to speak. But if you get a little bit, you can see Orangeville right here, just north of Caledon, very, very affordable. And the thing is, because of where it is, it's still commutable distance to the city. So if you're looking to make a move into an area that's affordable, that may be one of the affordable areas that you can actually get into. Now another chart here, it's very interesting on this, is I've had people say, well, I'm thinking of buying a single detached because I can make more money. Well, first off, it costs more money, and is it any different than buying a semi other than it being attached? And in some cases, the price increases we've seen, they're all pretty much the same across the board for single, semi, townhouses and apartments. But if you can go ahead and you can afford to pay that for a single detached, then that's awesome. But people that could be for a 1,300 square foot house or 1,400 square foot house. But there's also a buyer who's looking for a 2,000 square foot semi-detached or an 1,800 square foot townhouse. So there's different people for different products out there. Now this chart here talks about the balanced markets with prices in line with inflation. So what we're looking at here is inflation. It's pretty steady over the years, but then you start seeing some swings with regards to market with prices of homes. And so the MLS price graph right here in blue, you can see it's all over the place. And the last number of years we've up, and then we had this drop in 2009, and then it kind of rebounded with lower interest rates, and it kind of started to balance out. Now, one of the things that we can see with this one here is, remember we talked about like a buyer's market, seller's market, and a balanced market. Well, I don't normally like using those terms, but it kind of gives you an idea who's in control of what marketplace here. So when you have sales to listing ratio of 55% and above, you're up in the seller's market. Between 55 and 40, you're in a balanced market, and 40% below you end up in a buyer's market. So we haven't really been in a huge buyer's market very much over the last 10 years, so to speak. But this graph kind of puts it into perspective as to where things have been. Now this one here, the average MLS resale price, where the statistical data, where they think things may be going. Again, no one's got that crystal ball to make to be richer than rich. But what they're saying here is, it could possibly go up a little bit or it could go down a little bit. And that's generally price range of where they're thinking. Now, if you're an investor and you take a look at the RAIN network, newly completed units, carrying cost versus rent, what you're starting to see that their rents are increased. Where they're thinking is rents are going to continue to increase, but your carrying costs are going to increase. And one of those factors can be with mortgage rates. And as mortgage rates rise, you're going to have more carrying costs. And when you have more carrying cost, you're going to be able to get that from your rent. They're saying not so much. So there's different areas where more affordable to buy for rental properties. Is Orangeville a great place to rent? You know what? It is a really good place to rent. There's not very many rental places around, and when they are, they get scooped up pretty quick. But your carrying costs can be a lot higher. If you go to some areas like Guelph, Kitchener, Waterloo, really good area. You also have Kingston, which is another one, Aurelia, Hamilton. They may be better options than Toronto and Mississauga and Oakville and all those places. So, if you're an investor, that's something to think about. And then the risks to this, we all don't have crystal balls. We really, are all looking at the data going, where are things going to go? Is it going to go up a little bit or is it going to go up a lot? Is it going to go down a little bit or is it, so we really don't know. But, in each of these slides, hopefully you've been able to get a little bit of a nugget of information that may help you educate yourself, right? So if you want to talk a little bit more about this, or you want to know more about local marketplace, then you can contact me, David, at 519-215-0107, or you can send me an email at davidwaters@remax.net. Hopefully you enjoyed it. Glad I was able to share it, and we'll check back with you in another video. Bye for now.